You really wouldn't think the gatekeepers to, like, $1.7 trillion in global wealth would actually ask you to click on pictures of traffic lights to prove you're human.
Right. Yeah, it's pretty ironic.
It really is. But as we were digging through the source material for today's custom-tailored deep dive, we literally had to pass a bot check on MarketBeat, like, just to get access to the filings.
I mean, it is a funny little reality check.
Yeah.
Even in this, highly sophisticated, totally algorithmic world of high finance parties, someone still needs to verify that there's an actual human being on the other side of the screen.
Exactly. And that human element, that's going to be a massive recurring theme for us today, because we are looking at the Q1 2026 earnings release and the conference call presentation from Ameriprise Financial.
And those were published on April 23, 2026.
Right. Now, the mission here isn't just to read you guys a corporate spreadsheet. We really want to understand how a financial leviathan actually manages $1.7 trillion in assets under management and advisement.
Often abbreviated as AUMA, by the way.
Yes, AUMA. And how they manage that during a stretch of real economic volatility. We're looking for the blueprint here. Like, what do their strategic maneuvers tell us about where the broader economy is heading?
Exactly.
Okay, let's unpack this, because when you are staring at a $1.7 trillion operation, how do you even begin to measure if it's, having a good quarter?
Well, you start by looking for the delta between the headline numbers and the operational reality. So let's look at their financial scorecard for Q1.
Okay.
On paper, it was a phenomenal quarter. But the specific metrics they reported tell two very different stories about how that money was actually made.
Oh, interesting.
Yeah. So their GAAP net income per diluted share skyrocketed 66% to $9.68.
Wow.
But their adjusted operating earnings per diluted share jumped 19%, landing at $11.26.
Wait, let's pause there, because that is a massive gap.
It is.
Why did their GAAP net income shoot up 66%, but their operating earnings only went up 19%? Like, what causes a spread like that?
Okay, so GAAP stands for Generally Accepted Accounting Principles. It is the standardized, by-the-book accounting method that includes absolutely everything.
Right, the official numbers.
Exactly. It includes one-time tax benefits, restructuring costs, and crucially, mark-to-market valuation swings on their investments.
Ah, okay.
So when markets are volatile, GAAP numbers can swing wildly just based on paper gains or losses. Operating earnings, however, strips all that noise out.
Making it a cleaner metric.
Right. It looks strictly at the core engine of the business.
Yeah.
What did they actually earn from their day-to-day operations?
So a 19% jump in operating earnings is actually a much clearer indicator that the underlying machine is running hot.
Exactly the way to look at it.
Rather than just, like, benefiting from a lucky accounting break or a sudden market surge.
Yes. And their adjusted operating net revenues hit $4.8 billion, which is an 11% increase. But, the raw numbers are really just the output. To understand the input, we have to look at the architectural shifts they made in the quarter, specifically regarding their bank partnerships.
Because at this scale, institutions don't really grow by acquiring clients one by one, right?
Not at all. They grow by acquiring entire ecosystem.
And they definitely swapped out a massive ecosystem in Q1. The sources detailed the termination of their relationship with Comerica Bank.
Right, which was a huge move.
Yeah, and the filing notes this termination brought a one-time $25 million benefit, but it also accelerated the attrition of advisors tied to the Comerica program.
Naturally.
But they didn't just leave that void empty. They announced a massive new win. Huntington National Bank selected Ameriprise as its retail investment program provider.
And if we connect this to the bigger picture, that sequence of events is highly revealing about their strategic priorities.
Oh, so?
Well, letting go of Comerica and bringing on Huntington isn't just about updating the letterhead. Huntington is bringing in approximately 260 financial advisors and nearly $28 billion in combined advisory, brokerage, and insurance assets into the Ameriprise network.
That is wild. When I read the mechanics of that $28 billion transfer, it instantly reminded me of a blockbuster trade in professional sports.
Oh, that's a good way to look at it.
Right.
Yeah.
Like, you let go of a veteran player, in this case, the Comerica partnership, who maybe doesn't fit the offensive scheme anymore.
Yeah.
And you take a slight hit in the short term with some advisor attrition, but then you turn around and sign a massive free agent in Huntington.
Exactly.
But instead of a single player, you're absorbing an entire offensive line, a new playbook, and an instant boost to your team's overall stats. You are fundamentally upgrading the potential of your franchise.
That analogy holds up perfectly, mostly because a transition of this magnitude requires immense logistical heavy lifting.
Oh, I bet.
Yeah, I mean, when you absorb $28 billion and 260 human advisors, you are migrating technology stacks, you're moving client relationships, and integrating compliance frameworks.
It's a huge undertaking.
It
Huh?
is. And Ameriprise is willing to do that heavy lifting because they are hyper-focused on long-term, high-quality growth.
Right.
They are effectively buying a new, highly productive engine block to drop right into their wealth management vehicle. It's maneuvers exactly like the Huntington deal that helped push their total AUMA up 12% year over year to that staggering $1.7 trillion mark.
Okay, so they bolt on $28 billion in assets, but assets don't manage themselves.
Nope.
The money doesn't just sit in a vault. It has to be deployed. It has to be monitored, adjusted, which brings us to the actual people doing the heavy lifting, the advice and wealth management sector.
Which has undeniably become the crown jewel of Ameriprise's business model.
The numbers certainly support that. I mean, wealth management revenue is up 14% to $3.2 billion.
Yeah.
And they're operating with a pre-tax adjusted operating margin of 30%, which in the financial world, keeping 30 cents on every dollar of revenue as operating profit is phenomenal efficiency.
It really is top tier.
Total client assets grew 12% to $1.1 trillion. But the metric that really caught my eye here was wrap assets.
Ah, yes.
The sources highlight that wrap assets increased 16% to $664 billion. For the listener who might not be familiar with the jargon, a wrap account is where a client pays a single bundled fee.
Usually a percentage of the total assets, yeah.
Right. And it's for management, advice, and administrative costs, rather than paying a commission every single time they make a trade.
It is a critical distinction. The industry has been moving away from the transactional commission-based model for years now.
Why is that?
Well, wrap accounts align the advisor's incentives directly with the client's incentives. The advisor only makes more money if the client's portfolio grows.
Makes sense.
And for the company, it provides Ameriprise with highly predictable recurring revenue.
And the advisors managing those wrap accounts are hitting unprecedented numbers. The filings show advisor productivity reached a new high of $1.2 million per advisor.
That's a massive number.
It is. That is up 10% on a trailing 12-month basis. Plus, they recruited 61 experienced advisors in the quarter alone.
Yeah,
But I have to play devil's advocate here for a second.
go for it.
I want to push back on that $1.2 million productivity figure. Is that number actually a reflection of the advisors hustling, providing deeper advice, and doing more work for their clients?
Okay.
Or is this just a side effect of a rising stock market artificially inflating account values? Like if the S&P 500 goes up 10%, the wrap assets go up 10%, and the advisor's fee goes up 10%.
Without the advisor lifting a single finger.
Right, exactly.
Well, it's a very healthy skepticism to have. Market appreciation absolutely lifts all boats.
Sure.
If a client's portfolio grows organically because the broader equity market is rallying, the revenue generated from that fee-based wrap account naturally increases. However, the underlying operational data proves this isn't just passive market inflation. The advisors are genuinely driving new business.
Okay, what numbers in the filing actually point to that active hustle, though?
You have to look at the net flows. Ameriprise saw $6 billion in wrap net flows during the quarter.
Oh, wow.
Yeah, that is $6 billion of entirely new money coming into those fee-based accounts, not just existing money compounding.
Okay, that's significant.
Furthermore, they reported a 10% increase in transactional activity, specifically in annuity products and brokerage transactions.
Which shakes work?
Exactly. You do not generate a 10% increase in those complex products simply by watching the S&P 500 tick upward. That requires active, engaged advising.
Yeah, you have to actually talk to the client.
Right. It shows clients are coming to them for holistic financial planning, things like estate transition, tax-efficient withdrawal strategies, and, retirement protection modeling.
So the sheer complexity of the modern financial landscape is really driving people to seek out professional human help.
Yeah.
And it's paying off in client sentiment, too, because the sources note Ameriprise ranked third in the J.D. Power 2026 U.S. Investor Satisfaction Study for advised investors.
Which perfectly circles back to our initial thought about the bot check.
Right.
It proves that human advice commands a massive premium, even in an era where any retail investor can trade stocks or buy fractional shares for free on an app.
Yeah, Robinhood and all that.
Exactly. When markets get volatile, or when a client is approaching retirement and the stakes are suddenly much higher, They don't want an algorithm.
Yeah.
They want a human being to guide them.
So if their wealth management arm is printing money because clients want hands-on advice, how is the product creation side holding up?
Good question.
Because Ameriprise isn't just an advisory firm. They also manufacture the actual investment products and insurance policies that clients buy. Are their in-house funds seeing that same level of enthusiasm?
Well, that requires us to look at the asset management segment, which operates under the Columbia Threadneedle brand, and the retirement and protection solutions segment. Both of these divisions are facing very different macroeconomic headwinds compared to the wealth management side.
Let's start with asset management then. The headline number looks solid. Their total AUM increased 8% to $706 billion.
True.
But when you dig into the flows, they experienced net outflows of $5.9 billion. Put simply, more money left the funds than came in.
Yeah, that's the reality.
Now, what makes this fascinating is that the performance of these funds is actually stellar. Like over 70% of their retail funds are performing above the median versus their peers across 1, 3, and 5-year periods.
It's a great track record.
Columbia Threadneedle even ranked in the top 10 of Barron's best fund families of 2025 across all time periods. Here's where it gets really interesting.
Okay.
Having top-tier funds that are actively beating their peers but still bleeding nearly $6 billion in outflows is like trying to run a marathon with a parachute dragging behind you.
That's quite the image.
You have a world-class athlete the fund managers are visibly outperforming the competition, but the massive macroeconomic headwind of investors fleeing active management in favor of passive, low-cost index funds is the parachute constantly pulling them backward.
What's fascinating here is how you have to contextualize that parachute, though.
How so?
Yes, $5.9 billion is a massive outflow, and it definitely acts as a severe drag on earnings. But if you look at the exact same quarter last year, Q1 of 2025, their outflows were an astonishing $18.3 billion.
Wait, seriously? Wow. So they were bleeding 3 times as fast just a year ago.
Precisely. So that $5.9 billion outflow actually represents a 68% improvement year over year.
That completely changes the perspective.
It does. The entire active asset management industry has been battered by the shift toward passive indexing. What Ameriprise is attempting to do is rely heavily on that top-tier, highly rated fund performance you just mentioned to slowly turn the tide.
I see.
If your active management is demonstrably beating the median 70% of the time, year after year, eventually the institutional money stops leaving and the retail money starts returning.
Right.
They're patching a very large leak, but the trend line is finally moving in their favor.
I mean, a shrinking problem is still a problem, but at least the trajectory is promising.
Exactly.
Let's look at the other friction point, though. The retirement and protection solutions side. The earnings there dipped 12% down to $190 million. What's causing the drag there?
That dip is primarily driven by 2 converging factors. First, they are seeing higher distribution expenses, which is essentially the cost of marketing and selling new products.
Okay, that's normal.
Yeah. But second, they're experiencing continued heavy outflows from a very specific product-type variable annuities with living benefits.
Why are clients suddenly pulling their money out of those specific annuities? Is the product underperforming?
It's actually the opposite. The product is doing exactly what it was designed to do, which just happens to create a temporary structural drag on earnings.
How does that work?
These variable annuities with living benefits were incredibly popular legacy products sold a decade or more ago. They guaranteed a certain level of income for retirees.
Okay.
Now, that demographic is aging into their retirement years, and they are naturally beginning to withdraw that money to pay for their living expenses.
Ah, so it's just them cashing out.
It's an expected demographic runoff. To counter that inevitable drain, Ameriprise has pivoted. Their sales of structured variable annuities, which offer a different risk-return profile, more suited to the current market, remain incredibly strong.
Oh, nice.
Yeah, hitting $1.3 billion for the quarter. Clients still desperately want downside protection. They're just demanding it in more modern, flexible formats.
That makes perfect sense. The money isn't fleeing because they are angry. It's fleeing because they are finally using it.
Precisely.
Speaking of shifting demands, there was another data point that jumped out at me regarding the current macro environment.
What's that?
We are currently navigating a declining interest rate environment, and as a direct result, their certificate balances, which functions similarly to traditional bank CDs, dropped 29% down to $7.6 billion.
Yeah, and that is textbook macroeconomics playing out right on a balance sheet.
Right.
When central banks cut interest rates, The yield on fixed income products like certificates becomes significantly less attractive.
Because you aren't making as much interest.
Exactly. Clients and advisors are not going to lock their capital up for a 3% yield if they believe they can find better risk-adjusted opportunities elsewhere in the market.
Sure.
So as those old certificates mature, clients take the cash and deploy it elsewhere, causing those specific balances to just bleed off.
Which brings us to the ultimate question for any investor trying to understand a massive financial institution.
Okay.
We've seen the revenue engine humming on the wealth management side. We've explored the friction and the parachute effect in asset management.
Yeah.
We understand the demographic runoff in the annuity business. So the final question is, what does Ameriprise actually do with the massive amount of free cash flow this entire $1.7 trillion machine generates?
Well, the short answer is capital return. They return it to the shareholders, and they do it very aggressively.
Aggressive might be an understatement. I mean, in Q1 2026 alone, Ameriprise returned a staggering 88% of its adjusted operating earnings directly to shareholders.
A huge percentage.
It is. That equates to $936 million returned in a single 90-day window. This included the opportunistic repurchase of 1.6 million shares of their own stock at an average price of $475.
Yep.
And on top of that, they announced a 6% increase in their regular quarterly dividend.
They have the capacity to do this because their capital fundamentals are incredibly robust.
Right.
The filings highlight an industry-leading return on equity, or ROE, of 54.3% on an adjusted operating basis, excluding AOCI.
Oh, wait, I want to break down some of that jargon for the listener because it's crucial to understanding their financial health.
Sure, go ahead.
Let's start with that return on equity metric. 54.3% is massive, and they specifically note this is excluding AOCI.
Right.
Now, AOCI stands for Accumulated Other Comprehensive Income. It's a dense accounting term that basically functions as a holding pen for unrealized paper gains and losses, like the shifting value of bonds they haven't sold yet.
Exactly.
By stripping AOCI out, we get a much clearer look at the actual raw operating efficiency of the business.
Perfectly explained. A 54.3% ROE means that for every dollar of equity shareholder capital the company holds, they're generating over 54 cents in profit.
That is insane efficiency.
It is a highly calibrated, highly efficient profit engine. But you mentioned the share repurchases earlier, taking 1.6 million shares off the market at $475.
Yes, and I want to play the cautious investor for a moment here.
Okay.
Why buy back so much stock in a volatile market? I mean, if they have $2.3 billion in excess capital and another $2.3 billion in holding company liquidity, why not just hoard that cash for a rainy day?
It's a fair question.
We are in a declining rate environment. The market is unpredictable. Why take nearly $1 billion and essentially buy your own equity?
Well, this raises an important point about corporate psychology and executive signaling.
Okay, how so?
When a management team authorizes the repurchase of 1.6 million shares at $475, they are reducing the total number of outstanding shares.
Right.
That means every remaining share now claims a slightly larger percentage of the company's future profits. It is the loudest possible message a board of directors can send to the market.
Saying what, exactly?
They are broadcasting. We have stress-tested our models. We believe our stock is fundamentally undervalued by the public markets. Therefore, the single best, highest-yielding investment we can make with our excess cash right now is to bet on ourselves.
It's the ultimate confidence play.
It really is.
Yeah.
And they aren't doing it from a place of vulnerability either. That combined $4.6 billion in excess capital and holding company liquidity is what analysts refer to as a fortress balance sheet.
A fortress.
Yeah. They know they have enough cash reserved to absorb massive economic turbulence, severe rate cuts, or unforeseen market shocks in 2026.
Right.
Because the fortress is secure, they have the absolute freedom to aggressively shrink their share count and reward the investors who stay with them.
So, tying this entire deep dive together for you, the listener, why should you care about the Q1 2026 performance of Ameriprise Financial?
Right. Why does it matter?
Beyond just dissecting one company's balance sheet, these filings act as a highly accurate weather vane for how global wealth is moving right now.
Exactly.
Despite the proliferation of zero-commission trading apps, robo-advisors, and algorithmic trading, people are actively seeking out personalized, holistic, human financial advice. especially when the economic horizon looks unpredictable.
So true.
The firms that can successfully provide that human touch while constantly upgrading their technological infrastructure and maintaining a fortress balance sheet to survive the downturns, well, they are positioned incredibly well.
I think that captures the dynamic perfectly. And before we wrap up today, I want to leave you with one final kind of provocative thought to mull over.
Oh, let's hear it.
Buried deep in these source documents was a fascinating little detail about the current psychology of the American investor.
Okay.
Currently, there is a massive $47.8 billion sitting in third-party money market funds and brokered CDs entirely within the Ameriprise ecosystem.
Wait, nearly $48 billion just parked.
Just waiting on the sidelines. That is a literal mountain of cash earning a safe, comfortable yield.
Wow.
But as we discussed earlier, we are entering a declining interest rate environment. Those safe yields are going to shrink.
Right. They have to.
So if, or perhaps when, that $47.8 billion decides it is no longer satisfied with a shrinking yield and decides to re-enter the active equity markets in search of better returns,
Oh, man.
what kind of shockwave will that send through the broader economy? That is a tremendous amount of dry powder just waiting for a single spark.
It really reframes how you look at market potential. It makes you realize just how much kinetic energy is currently stored as potential energy, just waiting to be unleashed.
Absolutely.
Well, thank you so much for joining us on this deep dive. And circling back to how we started, maybe those bot checks on the financial websites aren't just a security measure.
Yeah, maybe not.
Maybe they're a subtle reminder. In a world increasingly dominated by automated trading and algorithmic market swings, the most valuable asset in the room is still the human being making the ultimate decision. Until next time.